Picture a highway at rush hour where every single car is jammed into one lane, bumper to bumper, barely moving, while the lane right next to it sits completely open. Nobody even glances over at it, because everybody just assumes the crowded lane must be the fast one, so they squeeze in anyway. That is exactly what is happening in the stock market right now. Almost every dollar flowing into this market is piling into the same handful of chip and AI names, and almost nobody is paying attention to 3 other stocks parked right there in that open lane, ready to move the moment traffic clears. Today on Ticker Hawk, we are pulling into that open lane, and by the time this video is over, you are going to understand exactly why the crowd is missing all 3 of these names, and why that might be exactly the opportunity you have been waiting for. Before we get into them, if you are the kind of investor who would rather find value while everyone else is fighting over the same crowded trade, go ahead and hit that subscribe button right now, because this channel is built around spotting exactly these kinds of setups before they show up on everyone else's radar. Tap the little bell too if you want to actually get notified, because it does no good sitting in your subscriptions list buried under 100 other channels. And once you are done watching, drop a comment and tell us which of these 3 you already own, or which one surprised you the most, because every single comment gets read. Here is what is actually happening underneath the surface, because it explains why this opportunity even exists in the first place. Chip and semiconductor stocks have grown into close to 1/5 of the entire S&P 500, a share of the index that has ballooned dramatically in just the last few years. 10 years ago, that slice was in the low single digits. Today, it is approaching 20%, which means the index you probably think of as broadly diversified across hundreds of companies is quietly leaning harder on one single sector than at almost any point in market history. For every dollar that pours into chips, that dollar has to come from somewhere else, and lately it has been coming out of some genuinely excellent businesses that have nothing to do with semiconductors at all. Layer on top of that some fresh tension out of the Middle East that has been rattling markets again this week, and you get a mood on Wall Street that is sitting firmly in fear territory, with the market's own sentiment gauge parked in the low 40s out of 100. Whenever that gauge drops into fear, it has historically been a decent time to start looking for value, not a time to run for the exits. It is worth saying clearly, fear on its own does not make a stock a buy. Plenty of things that get cheap deserve to stay cheap, which is exactly why we are going to walk through the actual numbers behind each of these 3 names, rather than just pointing at a falling stock price and calling it an opportunity. History also gives us a pretty consistent lesson here, and it is worth slowing down on for a second. Back during the dot-com years, money poured into internet stocks by the truckload. Valuations got completely disconnected from reality, and plenty of investors who chased that crowd ended up nursing losses for years afterward. But the businesses sitting quietly outside of that hype, the ones nobody was talking about at dinner parties, ended up being some of the best buys of that entire era once the dust settled and money slowly rotated back their way. That is not a guarantee this AI cycle plays out the exact same way, and it is not a prediction that chip stocks are about to crash tomorrow, because plenty of them are attached to real, rapidly growing earnings and not just hype. It simply means a lot of genuinely good companies have gotten cheaper for reasons that have nothing to do with how they are actually performing. And if you are investing for the next 5 or 10 years rather than trying to catch this week's headline, that kind of mispricing is exactly where you want to be spending your time and attention. One more thing before we get into the actual names, because I think it matters for how you use this video. None of these 3 are meant to be an all-in, bet the farm kind of move. The smarter way most people approach a setup like this is scaling in gradually, maybe starting with a partial position, and adding more if the story keeps confirming itself through the upcoming earnings reports, rather than dumping everything in on day one. That approach protects you if the timing turns out to be a little early, and it still lets you participate fully if the rotation plays out the way the numbers suggest it might. Keep that in mind as we go through each one. The first name might surprise you because it has been beaten down hard, and that is Netflix, ticker symbol NFLX. Shares are sitting roughly 40% below their highs from earlier this year, and when you actually dig into why, the story is mostly sentiment, not fundamentals. Revenue has climbed every single year without exception. Profit over the trailing 12 months is sitting north of $13 billion. Margins just touched an all-time high. Return on equity is sitting near an incredibly high 50%. And the company keeps shrinking its own share count through steady buybacks, which means every remaining shareholder owns a slightly bigger piece of the pie with each passing quarter. Free cash flow over the last year came in close to $12 billion, which is the kind of cash generation that lets a company keep buying back stock and reinvesting in new shows and games at the same time without ever needing to take on excessive debt. Here's the number that really stands out, though. Over just the past year, Netflix's valuation multiple has come down by roughly 40%, which means you are paying dramatically less for the exact same growing, profitable business than investors were paying 12 months ago. Part of that story is the advertising tier, which has quietly become the company's biggest growth engine. It pulled in the majority of all new signups this past quarter. The number of advertising partners working with Netflix has jumped by around 70% in a single year, and management is guiding for total ad revenue to roughly double before this year is even finished. If you have ever wondered how a company can grow this consistently, expand into an entirely new revenue stream, and still trade like it has fallen out of favor, this is a textbook example of a stock getting swept up in a rotation that has nothing to do with the actual business underneath it. And here's the real catalyst to watch closely. Netflix reports earnings next week, and this stock has a long history of moving hard in one direction, or the other right after results come out, sometimes gaining or losing double-digit percentages within a single session. If that reaction is positive, this could be the spark that gets shares climbing back toward their old highs, and a number of analysts already have price targets sitting meaningfully above where the stock trades right now. If you are watching this before those earnings land, keep this one on your radar. Because the setup is already there, we are simply waiting on confirmation before making any real decisions. Quick favor, before we move on to the second name. If this kind of breakdown is useful to you, go ahead and tap that like button. It genuinely helps this video reach more people who are tired of chasing the exact same 5 stocks as everyone else. And if you know somebody, maybe a friend, a sibling, or even your own kid, who keeps asking you for stock advice, who has been sitting on cash waiting for a real opportunity instead of another crowded trade, go ahead and send this video their way. The second name is one of the highest quality businesses on the entire planet, and it is Amazon, ticker symbol AMZN. Amazon is spending more on artificial intelligence than almost any company on Earth, with capital expenditures guided at roughly $200 billion for this year alone, and cumulative spending through next year now tracking well above $300 billion. Normally, that kind of number would make me nervous, because plenty of companies are spending heavily on AI with no clear proof they're getting anything back for it. Amazon is different. The overwhelming majority of that spending is going straight into AWS, and it is getting monetized the moment it comes online. Demand for cloud computing capacity is running so hot that AWS growth just re-accelerated to its fastest pace in more than 3 years, with the division's annualized revenue now running above $140 billion on its own. Amazon's custom AI chips, the ones built in-house instead of purchased entirely from outside chip makers, have quietly grown into a multi-billion-dollar business too, expanding at a triple-digit pace, which gives the company a level of control over its own AI costs that very few competitors can match. On top of that, management has also been tightening the belt elsewhere in the business, trimming thousands of corporate roles to keep overall spending disciplined even while AI investment ramps up. And the company is still sitting on a healthy net cash position that gives it plenty of room to keep funding this build-out without straining the balance sheet. Revenue climbed double digits last quarter, comfortably beating what Wall Street had modeled, and profit came in well ahead of expectations too, which tells you this spending is not just a bet on the future. It is already paying for itself in the present. Shares have pulled back from their all-time high, but they remain inside a trading range that has held for months now, the kind of setup patient investors tend to like rather than fear. Analyst price targets on this stock are mostly clustered somewhere between $280 and $325, a meaningful gap above where shares sit today. Think about what that actually means for a second. This is not some speculative story stock riding hype with no earnings behind it. This is one of the largest, most profitable companies in the world, growing its most important division at its fastest pace in years, and it happens to be sitting on sale simply because investors got distracted chasing chips instead of looking at the company quietly building the infrastructure those chips actually run on. And keep in mind, this is still the same company that dominates online retail here in the United States, with a major seasonal shopping event coming up this quarter that historically gives revenue an extra boost, on top of everything AWS is already doing. When you put the retail engine, the advertising business, and the cloud computing division together under one roof, it becomes pretty clear why so many analysts consider this one of the safer ways to get exposure to the AI build-out, without betting the house on a single unproven story. The third stock might be the most interesting setup of the 3, purely because of how sharp the pullback has been, and that is Micron, ticker symbol MU. Every single AI chip built anywhere in the world needs memory to actually function. And as demand for AI computing keeps exploding, demand for high bandwidth memory explodes right alongside it. Supply simply cannot keep up with that demand, which is exactly why prices and Micron's profits have been climbing so fast this year. Micron just posted quarterly revenue that came in more than 4 times higher than the same quarter a Year earlier, gross margins landed above 80%, a level almost unheard of for a memory chip maker historically, and management is guiding for another sizable jump next quarter on top of that. Despite that kind of growth, the stock is trading at a forward price to earnings ratio under 7, a valuation you would normally expect to see on a company in decline, not one of the fastest growing businesses in all of technology. Right now, Micron also just signed a major new multi-year supply agreement with Anthropic, one of the leading names in artificial intelligence, to help co-develop next-generation memory and storage, which pushes its total count of long-term customer agreements into the double digits and locks in more than $20 billion in upfront customer commitments, giving the company a level of revenue visibility that memory makers almost never get to enjoy. Micron has already sold out its entire high-bandwidth memory supply through the end of this year. Now, to be fair, this has not been a straight-line higher, and it is worth being honest about the other side of the argument. The stock recently pulled back close to 30% from its June highs, and at least one well-known short seller, Michael Burry, has publicly disclosed a bet against it, arguing the run has gotten ahead of the fundamentals, and that memory has always been a brutally cyclical business where today's shortage can turn into tomorrow's glut once every manufacturer rushes to add capacity. That kind of disagreement is exactly what creates opportunity, because if you like this business up near its highs, there's a real case to be made that you should like it even more after a pullback like this, especially with a memory shortage that shows no sign of easing anytime soon. Keep an eye on the broader memory sector this month too, since a major competitor, SK Hynix, is preparing a large public listing in the United States that could bring even more attention and even more capital back into this entire corner of the market. Samsung and SK Hynix are both racing to add their own capacity as well, which is a fair long-term risk worth watching, because eventually more supply tends to cool off pricing in any commodity-style business. For now, though, Micron's long-term agreements give it far more pricing visibility than it has ever had in a past cycle, which is a meaningfully different setup than the boom and bust memory cycles of years past. So, there you have it. One clean way to play the AI boom directly through Amazon and Micron, plus one incredibly consistent business in Netflix that got caught up in a rotation that has nothing to do with how well it is actually performing. Whether you are still 10 or 15 years out from retirement or you are already living off your portfolio today, this is exactly the kind of moment where patience tends to get rewarded because the businesses themselves do not actually care which lane the crowd happens to be standing in. Circle back to that highway from the start of this video. Right now, almost everybody is stuck in that one crowded lane, watching the same handful of chip stocks inch higher together while barely moving. These three names are sitting in the open lane right next to it, and open lanes rarely stay open forever because eventually somebody notices, and then everybody notices at once, and by then, the deal is not nearly as good. None of this is financial advice, and it is not a recommendation to buy, sell, or hold anything. Markets carry real risk and results always vary, so make sure you're doing your own homework and thinking carefully about your own situation before you put a single dollar to work. Let us know down in the comments which of these three you are watching the closest. Hit subscribe if you have not already so you never miss the next breakdown, and we will see you in the next one right here on Ticker Hawk.